everybody. In this lecture, we are going to be talking about the percentage of completion method for revenue and profit recognition. So, up to this point, we've been spending a lot of time talking about your normal revenue recognition where you just sell a product or provide a service, and it's a very quick turnaround time. So, most revenue in that case is going to be recorded when it's fully earned, 100%. So when the delivery is made or when the service is provided, all the revenue will be reported. However, there are some situations where we have a longer term project, and these may take multiple years, where you're incurring all these expenses, buying these materials, paying the laborers, incurring overhead, but the revenue under the normal, what's called the completed contract method, would not be reported until 1, 2, maybe 3 years later. So as you can imagine, looking at a company's income statement would be very skewed, because their first year would look horrible. They have all these expenses but no revenues at all. And then let's say the second year, all of a sudden they have a lot of revenues that really covers the project they've been working on for 2 different years. So that's the concern with these long-term projects. If you use the traditional completed contract method, then the results are going to be skewed, and you won't be able to really tell how profitable the company is on a year-to-year basis. So now the question is, so how do we report revenue? There are a couple of different methods, a couple of different categories here. We could be looking at output-based methods, and that's where we are selling. Yes, we have a long-term contract, in this case planes. We're manufacturing and selling a lot of planes to some buyer, some company that's buying from us. So in this case, yes, it's a long-term contract, but at least we can track the planes as they go out, and we can charge for that amount as the planes go out. We can record the revenue as each plane goes out. That's a pretty straightforward method that's really not too far off of the traditional completed contract method. We've sold a product. There's an identifiable product, and we record the revenue at that time. The other situation we could have, if we don't have a very easy output to identify and calculate, we could use input-based methods, which is basically showing our progress toward the completion of this project. It's used when we can't estimate the outputs. We don't have identifiable products going out. We're just building one big product, a big building, a big construction project. So what we may have to do is take a look at how much cost we've incurred and use that as a proxy for what percentage of completion we've accomplished at this point. So that is really the goal of this particular discussion, is talking about the percentage of completion method. We're going to see just briefly some alternatives in a little bit. But for this method, the percentage of completion method, we're taking a look at the total cost that we expect to have throughout this entire project. How much of that cost have we incurred up to this year, whether it be year 1 or year 2? How much of that total expected cost have we actually incurred? And that's going to be what we use to determine what percentage of the project have we completed. In that case, that's the percentage of the total revenue and the total profit that we're going to report up to that year as well. That's really the basis for this entire method. But before we get too much further into the percentage of completion method, I do want to talk just briefly about some alternatives depending on the situation. So as I mentioned at the beginning, the base model is the completed contract method, and that's when we record all revenues once the contract is 100% complete. Most companies use that, certainly short-term revenue generating companies that sell short-term projects or just deliver a product altogether, they use the completed contract method. Even though they may not call it that, that's essentially what it is. That's your general revenue recognition rule. The method we're talking about here is the percentage of completion method. And again, we record revenues and, I will say, profit as the project completion progresses. Now, I will say, if you have long-term projects like this, GAAP actually requires this method over the completed contract method unless you can prove that it's not really possible or feasible to make reliable estimates of those items that are needed for this calculation, like revenues, expenses, and progress towards completion. If you can't make those estimates reasonably, then you're back to the completed contract method for the most part. So again, just to stress, this is the one we're talking about mostly in this discussion. I do want to throw two more at you that come up in certain situations, really where there are installment sales being made. And what this essentially means is the customer's paying over time. So it might not be a long-term project, but it might be that the customer is paying over time, even though the payments may be over time. That's the key thing here. So what I want to show you about that is that we have a sale that's being made, maybe a big sale, maybe a relatively small sale, but the customer is allowed to pay over time. So what happens in this case is, under the installment sales method, revenues and costs are only recognized when the cash payments are received. And when this takes place, each payment that comes through, part of it's going to be considered recovery of the cost, and part of it's going to be considered gross profit. So every payment that comes through gets split out between those two components. However, in that same situation, if there is risk that you don't know for sure if you're going to even collect all the revenue, in that case, we might use the cost recovery method instead. And what that would basically mean is that all cash collections are going to go to the recovery of cost first. In other words, we're not going to record any profit until we're 100% sure we've covered all of our cost. And then in those later years, later periods, we'll be reporting the profit at that point. So we'll have different discussions on these two methods, but I just wanted to bring this up in the overall discussion of the long-term revenue recognition methods in general. Again, this discussion today covers the percentage of completion method. So here we have a couple of things we need to calculate and determine. When are we going to recognize profit and when are we going to recognize revenue? That's really the key thing with these calculations with percentage of completion, which arguably is the most complicated of this group. Of these four that we've talked about, this one is the one that takes most of the calculations. So let's take a look at profit first. We know that profit is basically total estimated revenue minus total estimated cost. Because keep in mind, I guess with revenue you probably know what it is because it's a contract. You've bid on that amount, so you know the contract price. So generally that's a total revenue, total known revenue for the entire project. But the cost really is estimated. You assume you know how much cost it's going to take to complete that project. But as the period goes on, you may find out that you were wrong and costs may increase or decrease. So for that reason, the estimated or the gross profit itself is estimated. We just have to remember that. So the question is, how much gross profit are we going to recognize this period? So the way we do that is we take that total estimated gross profit from up above and we multiply it by the percentage of completion to date. The percentage of the project that has been completed to date. That tells us up to this point how much gross profit should we have incurred or should we have recorded. Let's say we're in year 2 or 3 of this project. Up to the end of this year, how much gross profit should we have reported? But we have to subtract out the profit we've already recognized in previous periods because obviously that's already been recognized. We can't recognize it again. Now again, what we're going to see, really the key thing to this entire method is understanding that percentage of completion method or that percentage of completion itself. It's based on the percentage of total costs incurred to date. So what have we incurred, both actual from prior years plus what we know we incurred this year, divided by all those costs that I just mentioned, plus what we estimate are still expected to need to be incurred in future years. So costs incurred, again, we already know those, whether it be this year or in prior years. We know the costs we've already incurred, divide that by what we think the total costs for the project are going to be, which again, it includes the same thing as the numerator, the costs we already know about, plus it has to include what we think is left. So we'll see that in just a bit. We'll see the illustration for that. Now, I do want to mention, this slide is essentially the same, only now we're talking about revenue, because that same percentage of completion applies both to the calculation of gross profit and the calculation of revenue. That being said, if you know one of them, if you know either gross profit or revenue, because you already know cost, you're going to have to know cost. That's a key component of the problem. So if you know either gross profit or revenue, you can back into the other one, because obviously gross profit equals revenue minus cost. So if you know revenue and cost, you can easily back into gross profit. On the other hand, if you know gross profit and cost, you can back into revenue. But another way to do it, just to make sure your calculations are right, is calculate both gross profit and revenue and make sure everything works together, everything fits. Again, we'll see this in just the next slide, actually. So it's the same thing. Revenue recognized this period, or revenue to be recognized this period, equals the total estimated revenue, which is usually a contract price that's given to you, multiplied by that same percentage of completion up to this point, minus any revenue we've already recognized in prior periods. It's still the same percentage of completion we're using for both gross profit and revenue. So here is a project. Now I have two different slides here, or two different screenshots, because this one on the left assumes we were just trying to calculate gross profit and figure out how much profit to recognize in the current year. The one on the right does that same thing, except we're doing this by calculating revenue. Revenue minus expense equals gross profit. This one on the left, just to reiterate, it goes straight to gross profit. So we'll talk about both of them and we'll see how they work together. So when you see a problem, which by the way, we will have another slide or another video that goes through a full-blown example of this, an actual problem, and we'll develop these charts and these numbers. But this is just giving you an overview of what these things mean when you calculate them. We have the contract price, which is usually given to us in the problem, and for the most part it usually stays the same. It can get quite complicated if the revenue is variable, if it changes for some reason. But for now we're assuming it's $5 million for the entire contract. We know that up front. No matter what our costs are, we know we're only going to collect $5 million in revenue. So then we're taking a look at the construction costs. Now, we know what we're incurring each year because we're buying the materials, using the materials, we're using the labor, all of that. We also obviously know what we've incurred in prior years because in this example, in 2017, we incurred $1.5 million. So by the time we get to 2018, hey, we know we've already incurred that, plus we have an extra $1 million for 2018. It just accumulates over time. So the total actual cost to date is just a sum of what we incurred in that current year plus what we've already incurred in previous years. And obviously it's growing. Notice by the time we get to the very end here, we have a $5 million revenue, and at that point we've incurred $4.1 million in actual costs. So we know right off the bat that we have $900,000 in profit. That's the actual amount by the time we get to the end of 2019. Just kind of note that. It's not a loss, because if it was, we have to take that into consideration. But right now, we are eventually earning a profit. So the other thing that will be given to you generally is the estimated remaining costs for the project. So this could change over time. By the time we get to the end of the third year or the last year, this has to be zero. But notice, again, this will change over time. In fact, if we take a look at this, at the end of 2017, we said, hey, you know what? We think we have $2,250,000 in costs left for the project. But if you take a look at what costs we actually incurred in those last 2 years, it ended up being $2,600,000. So we were off in our estimate of 2017. We incurred more than we expected. And again, that's just what happens sometimes. You can also see that down here. At the end of 2017, we thought our total costs were only going to be $3,750,000. But after all is said and done, at the end of 2019, our total costs were truly $4,100,000. Sometimes they'll go up, sometimes they'll go down. You just have to deal with it and your problem. So our total gross profit at each point is basically revenue minus all these costs. And, again, our gross profit, we thought it was going to be $1,250,000, but over time that estimate ended up shrinking quite a bit. So that's the total gross profit that we know at that point. We multiply that by the percentage of completion, because again, in this screenshot, we're using that gross profit to determine, we're not even bothering with revenue really, we're just using the gross profit and figuring out how much profit should be recognized in this year. So that's why we're starting with the total gross profit, multiplying it by a percentage of completion, which again, I would argue this middle piece is the key. It's probably the most important of this entire problem because it's used for either gross profit or if you do it the revenue route, which we'll see in a bit. But it's a rather simple calculation. It's the actual costs up to this point divided by the total expected costs for the entire project. So if you set up a chart like we did here, we kept track of the total expected costs every step of the way. Even though they changed, our estimate changed, we kept track of it. Now remember, total expected cost, it includes what we've already incurred plus what we think is left. So notice how this $3,750,000 is down here, this $4 million is down here, and this $4.1 million is down here. It's the same number. The numerator to that fraction is going to be what costs have we incurred up to this point. Not what cost did we incur just this year, except obviously the first year that's going to match that number because there's nothing in prior years. But let's go to year 2. Actual cost to date, it's not just the $1 million we incurred this year, it's also the $1.5 million we incurred in the previous years. So it's a total of $2.5 million that we've actually incurred. And at that point, because we thought there was still $1.5 million left in the last year, so we thought the total costs were going to be $4 million. So we've already incurred $2.5 million out of the expected $4 million. At that point, we're at 62.5% completion. Now, obviously, by the last year, we're going to be at 100%. So whatever our actual costs were, they all of a sudden become the total expected cost because there's nothing left. So once we get these percentages under this method, we just take the 40%, multiply it by the gross profit that we are estimating at that point, and that tells us we need to, up to this point, record $500,000 in gross profit. Obviously, for year 1, nothing else has been reported yet, so that entire $500,000 gets reported this year. In year 2, we have an estimated 62.5%. Our profit is now a little bit less. Our profit estimate is less, but we want to make sure we're up to 62.5% of it. So that means by this point, between last year and this year, we need to have reported $625,000. We know that we already reported $500,000, so that means we have $125,000 left to report this year. In 2019, now we know our profit's going to be only $900,000. We need to make sure we've reported all of it at this point. So $900,000 minus the $625,000 we've already reported, $500,000 and $125,000, tells us we still have $275,000 left to report. So that's one way you can do this if you're just concerned about calculating profit, we already know what the expense was, and then you can back into revenue to report each year. But if you want to calculate the revenue, then you can take that same percentage of completion, same ones we calculated before, multiply them by the contract price, which is the total revenue, and that'll tell you the total revenue that you need to have recognized up to this point. Obviously, again, in year one, we didn't report anything in a prior year, so that full $2 million needs to be reported this year as revenue. Now, if we want to, we could stop there and say, hey, we have revenue. But if we also want to get gross profit, we just have to subtract out the expense we've incurred just this year. That was only $1.5 million in year one. So if we record $2 million in revenue and we've incurred $1.5 million expense this year, that tells us that we only have $500,000 of profit to report this year. So let's go to year two. Now, by this point, we should have recorded 62.5% or $3,125,000 of revenue. We already recorded $2 million last year, so we need to report another $1,125,000 in revenue just this year. And in this year, we've incurred only, again, just this year, incurred during the year, $1 million in costs. So we subtract out the $1 million in costs, and we get $125,000 in gross profit to report just this year. Notice these first two items, they match perfectly with the gross profit we calculated under the first method. So does the third year. So these methods reconcile. That's my key point. Third year, same thing, $5 million. We need to record all that revenue by this point, but we've already recorded $3,125,000 between the 2 years. So we have $1,875,000 left to report, minus just the $1.6 million expenses incurred just this year, and that gives us our remaining $275,000 of gross profit. So what I would suggest anytime you're dealing with a problem related to the percentage of completion, put together a chart something like this, and first of all, you'll have to figure out what does your particular problem ask for, so what do you need to enter. This will give you all the data related to it, but you may only need a few pieces of it. When we do the journal entries over the next few slides, you need a chart like this to figure out your amounts. So the next few slides are basically dealing with your various entries that may be required throughout this entire project. First of all, if you incur some new construction costs, then what you're going to be doing here is debiting this construction in progress, which is kind of like just an asset or a temporary asset account, if you want to call it that. And what this is doing, it's recording both the cost you're incurring plus the profit you're recognizing. So you debit this, what we'll just call it an asset, if you will, and you credit the cash, either the cash if you're paying cash, you're crediting materials if you're using up materials, you might be crediting salaries payable if you're recording labor costs. So this credit, you'll need to look at what cost you're talking about. Now this is where the construction in progress comes into play. This is when we're recording revenue and profit. So notice, let me go back here a second. We debited this construction in progress previously, and now we're recording revenue and profit along the way. So now we're going to be debiting an account called cost of construction, and again, different textbooks, different companies might use a slightly different term, but this debit to cost of construction represents the actual cost you've incurred this year alone, not any prior years, just this year. If you have profit, you're also going to be debiting construction in progress to report that profit. And then, of course, you're going to credit revenue for whatever amount of revenue needs to be reported this year. So if we go back to our chart, we have all of these numbers. The cost incurred this year, the profit to be recognized this year, and the revenue to be recognized this year. So we've got everything we need out of those charts. Here's the key thing. If we have a loss just for that 1 year, so let's say our estimates were off, and now we realize that the total amount of revenue or profit, well, let's say the total amount of profit we should have been recording up to this point is actually less than what we've already reported. As such, we have a loss. We've taken too much gain or profit in the prior years. We need to record a loss to offset it to get it back down to exactly where it needs to be, which we'll go through some of these examples in the later video. But two of these three pieces of this entry are always going to be the same. You still debit the cost of construction for actual costs that year. You still credit revenue for the revenue that year. Now the difference is, instead of debiting cost or construction in progress like we did in the last slide for a profit, now we have to credit it for a loss. That's the key thing. That's how you record the loss. Now, this is assuming that we have the project is going to be profitable, but just this 1 year we had to record a loss to offset an earlier invalid estimate. However, if we know that the entire project now is going to be unprofitable, so in other words, our cost estimate now takes us above our total revenue, so we know, unless something changes in the later years, we now think this profit is going to be a total loss. In that case, we have to be conservative, and it's not enough just to report what we've been doing up to this point, up to that year. Instead, whatever total loss we think we're going to have on this project, based on this estimate, we now need to make sure all of it is reported this period. All of it, in other words, the total gross profit we're reporting up to this year would actually be a loss. So that'll require an adjustment when we consider all the prior year's profit or loss plus this year we're now reporting. It has to equal the total loss we expect for the entire project. Even if we have years left to go, all of it has to be reported up to this point. Again, we'll see a more in-depth description of that, or explanation, example I should say, when we go through the examples in the later slide or later video. The next one's pretty straightforward. This is just to record billings. So we're going to debit accounts receivable and credit the billings on construction contract. So this account, billings on construction contract, you may question, what is that? You may not have heard of that type of account before. What I'll tell you is it's either a liability or an asset, depending on its relationship to the construction in progress account. So we hear the word construction quite a bit, 3 different times. This one, the construction in progress, and the cost of construction, we hear that term 3 times. This particular one, if that construction in progress is greater than these billings on construction contract, then this would essentially be an unbilled receivable asset. Basically, we haven't billed it yet, but we know we have the money. If we have billings on construction contract that are higher than our construction in progress at that point, it's like an unearned revenue. It's a liability. We've billed more than we've actually earned, so to speak. Cash collections are straightforward. It's a debit to cash, credit to accounts receivable. Nothing tricky there. And then after all is said and done, once the entire project is completed, we have to close out that billings on construction with the construction in progress. By this time, the two should be the same amount if we're at the end of the project. So in that case, we're going to close them out. We'll debit the billings on construction, credit the construction in progress, and we'll be good to go. Those two are just temporary accounts. Hopefully that has helped to clarify some of the topics you might see with the percentage of completion method. Again, we're going to be going through examples of this both with profit and loss in later videos, but this should give you an overview of the journal entries necessary and the basic computations behind it. So thanks for your time, and I'll talk to you in the next lecture.